Hello, this is Eric Parnell, Chief Market Strategist from Great Value Advisor Group. It has been a wild week here in the markets. We had a big turbulent day on Monday with the tech stocks moving sharply to the downside, and we come into this Monday and we have tariff wars breaking out all across North America and the rest of the world. So what does this mean for the markets? It certainly caused understandable panic for investors, but the reality of it is that stocks have been holding up quite well despite the volatility, and we see the S&P 500 continuing to hover near all-time highs. This doesn't mean that we should be complacent, however, because the downside risks are going to continue to persist through the first half of 2025 and potentially through the rest of the year. The key element that we need to keep our eyes on is not the trees that we're seeing all along the way, but the broader forest. There was so much talk and chatter about the tariffs that came to the market on Monday, but it's not about the specific headlines. It's about the bigger picture. Are tariffs inflationary? Absolutely. But it's not about the details of the tariffs. It's about the cumulative effect of all of the different policy measures that are being put in place under the new administration and for the broader economy in general. As we go through the year, we need to keep our eyes on the broader inflation measures. That's the number one downside risk to the markets as we go through the remainder of the year. We're going to hear a lot of noise, but as long as markets continue to receive the liquidity that they need, and we continue to see corporate earnings rise at the double-digit pace that they're set to forecast, stocks should do just fine. But on the flip side, if we see inflationary pressures continue to build the way that they have been over recent months, and it starts to become a problem, that's the issue that could unravel financial markets. So where are we today with inflation? We got the latest reading on inflation, the Personal Consumption Index, which is the Federal Reserve's favored measure of inflation that came out at the end of January. The numbers look good, both the headline and core inflation rate under 3%, but these numbers have been slowly rising in recent months, particularly on a headline basis. We got to keep an eye on these numbers in the coming months. Another key metric to watch for is the 5-year break-even inflation rate. This is a measure that gives the market's forecast for inflation over the next 5 years. Now, a level that I've been watching for months is the 2.5% reading, which is saying that investors are expecting an average inflation rate of 2.5% over the next 5 years. That's totally doable for the markets and the economy. But recently, we've seen this number rise above 2.6%. If this keeps climbing towards 3% and beyond, that could be signaling that we got an inflation problem that the Federal Reserve has to start to deal with. And how do they do that? By potentially raising interest rates. And the markets aren't going to like that very much. This all brings us back to the key point that we should always keep in mind. Coming into 2025, it's a new year and it's a new administration in Washington. We're going to see headline risk and we're going to see points of market volatility along the way. But we knew this coming into the year, and we'll continue to know it in the months ahead. More than anything else, the key is stick to your long-term discipline and your long-term investment philosophy. That will enable you to weather any periods of short-term volatility in order to stay on track with your long-term goals. Thanks for joining me for this latest market insight, and I look forward to seeing you again soon.